Q3 earnings. Good morning, everyone. In case you've never been here before, this is the Fiscal Philosophy YouTube channel. Welcome. I'm your host. I consider myself to be a value-oriented investor, and I do own shares of MPW. I actually got up bright and early this morning in order to not miss a moment of that earnings conference call, which I listened to in full. Medical Properties Trust, just to catch you up, is one of the largest owners of hospitals, private owners of hospitals in the world. They have over 400 properties, over 40,000 beds in 10 different countries. Used to be 11, but they sold out of Australia. And those hospitals are rented out to 55 different operators. MPW so far has had a really turbulent year with their share price crashing over 50% year to date. Now, year to date measures are not necessarily indicative of the value of the company, but needless to say, this wouldn't happen if everything was going fantastic. One of the driving factors in MPW's collapsing share price this year has been issues with one of their largest tenants, Prospect. It came to light earlier in the year that Prospect had been failing to make its cash rent obligations. Now, MPW accepted some non cash items in lieu of rent, and this quarter, of the 38 cents per share of normalized funds from operations that MPW produced, 2 cents per share were in the form of non cash items from Prospect. However, maybe more importantly, cash rent payments were received from Prospect in September and October as previously anticipated. The analysts seem more or less evenly split between a buy rating, hold rating, and sell rating. But when you look at the actual price forecasts, you see how wide the chasm truly is between analysts on this particular company. I tend to believe that the low estimate here is more based on the fact that the stock has dropped a lot lately, more than any actual financial measurement of the business. They basically believe, oh, it's dropped a lot lately. It's in something of a downtrend. So we think 12 months later, it'll be even lower. The average, I think, just ended up there because there's such a big difference between the high and the low that the average just kind of ended up being basically on the dot in the middle. With the high side, I think more being focused on the assets and potentially multiples of funds from operations. Speaking of the assets of MPW, they currently have just over $19 billion of assets with $10.7 billion worth of liabilities. This leaves them with total equity of right around $8.3 billion. This is on a market cap of $3 billion. That leads to about $5 billion in total upside. Broken down on a per share basis, that equates to a $5 share price with about a $13.84 book value, meaning hypothetically, based on just the net assets, the stock should be more in the $13 or $14 range. Speaking of the debt, this is a maturity schedule of principal payments due over the next few years. My understanding is that at this point, 23 and 24 have been mostly cleared up. These numbers are from August. And the big concern is, of course, the large jump in maturities in 2025 and especially 2026. But they did mention on today's earnings call that they would expect to raise around $2 billion in new liquidity over the next 12 months. They mentioned possibly pursuing secured debt or potentially doing some strategic asset sales. And they mentioned that the unsecured debt market is probably not an option for them at this point. They also did not really care to publicly speculate as to what kind of interest rates they might get on debt refinancing, but they did mention that they might prefer that over selling long-term performing assets, because they think if rates were to go lower, they could always, refinance again at lower rates. And they did mention that if they do need to liquidate some assets, that there has been significant interest from different types of buyers at levels that are actually higher than what they said were reflected on the balance sheet. One X factor I think is interesting to look at, and shouldn't be ignored, but also shouldn't be the only reason to invest, is that this company is heavily shorted. Short interest in MPW is currently over 22%, according to Fintel. For comparison's sake, AMC is currently under 8% shorted. Oatly is under 9% shorted, and even GameStop is slightly under 22% shorted. And these stocks are often discussed and have a high level of retail interest for the short interest and the short squeeze potential. Now, Medical Properties Trust is different from those stocks in that it pays a dividend, and the shorts are actually required to cover the cost of the dividend while holding short positions. When it comes to the valuation of Medical Properties Trust, I primarily am looking at the balance sheet at this time. While, sure, if it got the same amount of retail interest as, say, GameStop or AMC, there could be something to that short interest, but I don't hang my hat on that. I don't think that it's wise necessarily, for my purposes, to get into a stock where I've only got one way of winning, and it's only if a very specific thing happens. With MPW, I think ultimately they have a strong balance sheet. Management has indicated that it may even be stronger than it looks based on the interest they've been getting in some of their properties from buyers, according to what I was hearing on the earnings call. So the balance sheet is what I'm most comfortable basing my valuation on. Now, I also, of course, enjoy collecting the dividend while I'm patiently waiting for the value proposition to play out. Of course, there's headwinds. They have a lot of debt, and they have to effectively manage their cash in order to either pay down or refinance that debt. They have said that they want to avoid liquidating, high quality assets if possible, but if necessary, it seems like that's an actual option. Hospitals, in my view, are much different from offices or malls or even retail, right? These are, actual, in many cases, essential infrastructure to the communities that they serve. And overall, in the long run, I am a healthcare bull. We have an aging population. People are living longer and longer, but the side effect of that is that the longer your life goes on, the more healthcare you tend to need, especially in the second half. So, with all that being said, I really clock this thing in right around $14 per share. I realize that's kind of close to the high analyst estimate, but it was arrived at completely on my own, and I would never really buy, sell, take any action purely on the basis of analyst estimates, purely on the basis of something like short interest. There's got to be something financial backing it up for me, and that's really how I arrived at that. You could also, be like Chuck from Fast Graphs and go with multiples of funds from operations and come up with like an $18 valuation on this potentially. But I'm more comfortable at the $14 level. I think that's not maybe the most conservative, but I think it's realistic, and it's certainly not the most optimistic either. So let me know what you think. Do me one last favor. Make sure that you subscribe to the video, give the video a like, comment below with your own thoughts, and join us on Discord. Link is in the description. And please remember to catch me every Saturday night, 8 p.m., Cashflow Kings Live. Link is in the description. Take it easy, everyone.